Today I want to talk about bull and bear markets. This is part one. Bulls and bears alternate like a pendulum, as you can see, and they are in fact very much connected. A bull always creates a bear and vice versa. Why? The basic reason is that stocks are essentially worthless. Cash is gold. Cash is king. When the stocks are high, people like to cash out because they want to make profits. When the stocks are low, they cash in, put in the cash because opportunity calls. So the stock is only a means to an end. The end is the cash. Now you have to get into the beginning of the bull market, not the end. There are two factors. First one is environmental, the overall condition. The second one is the fuel factor. Let's talk about the first one. What is the best environment for the bull market, for the beginning of a bull market? First of all, the recession is ending. It doesn't have to be a recession, at least the condition where business is down is ending. And we should have low interest rates, otherwise the bull doesn't come. And we also need to have company profits improving. It doesn't have to be good. It doesn't have to be positive, making money, as long as the profit picture is improving. Then we have the beginning of a bull market. And also, at the beginning of a bull market, we have a mix of good and bad news. Now the fuel factor, of course, is cash. You have to have plenty of cash sitting on the fence. The cash is idling outside of the market and they're waiting to come in. Stocks also at very low level like we have now after hitting bottoms. Now the bull runs longer than the bear. Why? Well, very easy. Because a bull run means improvements. And improvements take time to build. So a bull usually has 2 or 3 years to run. A bear probably half a year. Now this is the time to get into the market if you have the cash. As the bull gradually gaining momentum and is running towards the peak, you also need two kinds of factors, environmental and the fuel factor. Now, once the bull starts, you need something more to sustain it. You need sales. So you look at the company reports and their sales should be expanding. And they should be hiring more people. You need more people employed, then the bull will be sustained. Of course, interest rates still have to be low. And in other words, it's a boom time. The next factor is the fuel factor. Cash again, more cash coming in. But there are other things that can fuel the market, like merger and acquisitions. Because companies at this time, they have more cash, so they go out and try to buy other companies to solidify their market share. And also you will see initial public offerings. That means IPO, where private companies become public and offering stocks to the market. And during this time, we usually see more good news than bad news. The bull cannot run forever. The bull seldom runs for more than 3 years because the urge to cash out is very great due to the high prices of stock. Now, when the bull reaches the peak, that is a very dangerous situation. How do you know that the peak has reached? Very easy. When the bull reaches the peak, the economy is overheating. The whole society gets ecstatic. They are very happy about the boom time, but they don't know that the boom time is going to end. Now everybody will talk about the stock market. They will say that the stock market is the best place to get in. Who are the people who are so optimistic? Well, almost everybody, including janitors, taxi drivers, housewives, doctors, lawyers, and engineers. So when you see this kind of thing happening, you better get out soon. Now let me just use a diagram to describe the bulls and bears. We have two axes. Over here is time, and over there is the stock price. And suppose the bottom reached is about $5. And at the beginning of the bull market, you will see that the stock price is beginning to rise. And it doesn't rise in a straight line. It always go up, down, dancing up and down like this. It will take about 2 to 3 years to reach the peak. And then after that, it's going to stay there for a little while, and then it will start the slide. You don't know when it's going to come. It may be due to some bad news, or it may be due to something else. Now when it's going to slide, you know that the bear market has come down. When it comes down, you can also see that sometimes it goes up too. But it takes less time to get down, and then at certain time it's going to start a precipitous fall, falling very fast, and then you get back to the low level. Now this the bear market takes less than a year because everybody wants to get out.